happy that you can join us today. Monthly, we have been trying to pick out what is the most important topic for investors, retirees, people concerned about their finances should be focusing on, and trying to add some value here. First, before I go any further, this production would not be possible without the tireless efforts of Marcela Garcia. You may see her as a participant. She's going to keep us within the rails, on time, on point. Thank you, Marcela, for all you do. So a couple housekeeping items here. We so much welcome your questions. We're going to take them at the end. So how do you submit a question? Well, to start with, you can write in your questions right at the bottom there, Q&A. I think if you click on that, you can type it in. That way you won't forget them. That way we'll have them here. That may actually give us a couple moments to cogitate on them before the end of the show, and so we're ready for them. We're also going to have a poll here. Marcela, can you turn on the poll so people can see the poll question? So the poll question is quite simply on the stimulus package. When will it be passed? That assumes it will ever be passed. But you have two choices here. One is before the current President Trump leaves office, or after Trump leaves office, assuming he does. Yes, of course he will. And after Joe Biden has assumed office. So you're going to have a chance to vote, and we will take your votes during the course of the show here and then share the results with you. Thank you, Elaine, for putting that together. So I should also tell you that fortunately, I am not alone here today. I've got the invaluable assistance of Elaine Phipps. Elaine is a managing director and portfolio manager here at Point View. Despite her very youthful appearance, she actually has 25 years of experience in the financial services sector, from names that actually might be bigger names than Point View. That would include First Boston Corporation, Chase Manhattan Bank, Moody's, and MetLife. Elaine received her BA in economics from Holy Cross and has an MBA from NYU, and passed that grueling exam called the CFA. Of course, Elaine, believe it or not, does not work all the time. She also gives back to our nonprofit community a great deal. She has served as a trustee on our local Summit area YMCA and has been a big mover and shaker in New Eyes for the Needy, as well as the local PTO organization. And that's just to name a few. So we're lucky to have Elaine on board here at the firm and also for this presentation. I'm going to start with just a little bit of introduction as to Point View. Some of you don't know us well, and then I'm going to turn it back to Elaine for some things. So we are, as I mentioned, in Summit. We're proud to be an SEC registered investment advisor. Why is that important? That obligates us, in addition to what our temperament is, to observe the highest fiduciary standards. We are so proud, effective September 1 of last year, to be now part of PPAC Private, which is the wealth management division of PPAC Gladstone Bank, which has over $7 billion under management. Gives us a lot more resources. So what do we do here? We focus on managing people's and institutions' investments, but it is not a one-size-fits-all. It's customized for every situation. On top of that, under the great offices of Claire Toth, we provide holistic financial planning. Sometimes it's more important whether what type of an account you're investing in than what target you're throwing your dart at. Tax efficiency is what we are all about. Transparency. How do we achieve that? By using primarily individual stocks and bonds. We avoid non-transparent, expensive funds, whether they're traditional mutual funds or ETFs. Our relationship minimum is $500,000. Our fee is a flat 1%, which actually compares quite favorably to the competition because mostly they're just taking your money and putting into expensive funds, and now you have two fees. We also have a program where you can just do a financial planning deep dive. I think Claire sometimes calls it the financial colonoscopy. Anyway, we look at everything financially related, come up with our advice. You can take it, implement yourself, or you can take the next step and have us manage all or a portion of your money. And if you were to do that, your fee would be credited dollar for dollar against investment management fees. Finally, asset security is always so critical. All of our assets are not custodied here at Point View. They're custodied at world leader financial services provider Fidelity Investments directly in your name. So we're covered there. We have been so fortunate in the 27 years we've been in business here to be recognized not infrequently. CNBC acclaimed us as one of the top independent fee-only registered investment advisors in the country. Investopedia has also recognized us as one of the most influential advisors in the country. And then we were also recently recognized by Financial Advisor magazine. So we're very proud to have those recognitions. At this point, I am going to turn the show over to Elaine to start in with the meat of the presentation. Elaine, it's all yours.
Thank you, David. So election 2020 is over, we hope. Where do we stand today? Although President Trump has not conceded, the vote tally has elected Joe Biden president. The Senate, it seems poised to stay in Republican hands, but there is a January 2nd runoff for 2 Georgia Senate seats, which, if they go blue, will at best split the Senate. While the Democrats retain control of the House, it is by a smaller margin. So the blue wave did not materialize. The Democrats do not have that cherished trifecta of full party control, which would be the presidency, the House, and the Senate. Sorry. Okay, so key takeaways. Excuse me. Markets have historically done well, no matter who is in the White House, but the Democrats seem to hold a slight advantage. Here is some data on the S&P performance going back to 1926. When there is a unified government, that's control of the White House, Senate, and House of Representatives, Democrats and Republicans are almost equal with a 14.5% average rate of return for the S&P. Do note that the Democrats have had this type of advantage 21 years more than the Republicans. With a divided government, when the Democrat is in the White House, that return grows to 16% versus 7% for a divided government with Republicans in the White House. The caveat here, we shouldn't assume that the past will predict the future, one of our favorite investment lines. So here is a famous adage of one of our favorite investors, Warren Buffett, and I'm going to read this. It's a little small print for me, so pardon my reach here. I have watched politics for all of my life. Half of the time, I have had a president other than the one I voted for. Despite this, I have never sold stocks based on who's occupying the White House. If you mix your politics with your investment decisions, you're making a big mistake. And we could not agree more. This is the equivalent of don't let politics wag the investment tail. Fundamentals and the economy have been the drivers of markets, not what happens in Washington. You as an investor must keep the long-term view and hope that your portfolio will outlive many, many presidents. Another point to consider is that the market has already priced in commonly held views on the effects of this election. Now, if there is a surprise coming that we can't foresee, all bets may be off. No matter which candidate you voted for, exit polls and political strategists confirm that the health of the economy is a top issue for all voters. This year, of course, COVID, was mixed in with that. But a supportive economic policy is on the top of any candidate's to-do list as soon as they get into office. We don't expect that will change. And then finally, just when you thought it was all over and it was safe to turn on the TV again, the market will soon start to look forward and focus on the midterm elections, which are now less than 2 years away in 2022. So that's a little bit of excitement for you to look forward to. Here we're going to borrow another former president's famous line that elections do have consequences. So let's talk about stimulus. The stimulus bill, this would have been the second one, was held up in Washington before the election. Democrats wanting to do more than Republicans did dollar-wise. The general consensus was that the blue wave was going to lead to a larger stimulus, but that didn't happen. So now the market is anticipating that the split government will probably yield something in the $500 billion range versus that $3 trillion that was initially anticipated. There are still many stumbling blocks. Democrats want more aid to state and local governments hard hit by COVID. Republicans do not want to bail out states for non-COVID related liabilities, and they want immunity from litigation for COVID claims. Where we are today, the raging virus, it's back again and even fiercer, and the looming shutdowns, those things have grabbed elected officials' attentions. So the markets are hopeful things will get settled soon. With the news of promising vaccines, the hope is also that the end is in sight for this continued and prolonged stimulus spending. It's also a positive that the Fed chairman is out there continually arguing for more stimulus, saying you can't do too much. So we are optimistic that things will get done. Infrastructure. So the market also appreciates that Democrats have traditionally been the bigger spenders and taxers. This may boost infrastructure projects and benefit those workers who traditionally are members of that Democratic base. We can expect some Republican support as well. However, just last summer, the House passed a $1.5 billion infrastructure deal. That went nowhere because it was more of a new Green Deal versus let's fix the roads and bridges. So if the new proposals for infrastructure kind of go that new Green Deal way, they may have some difficulty passing. But at the end of the day, I think everyone wants the country back to work, Republicans and Democrats, and no matter what it takes. And if spending on roads and bridges is going to help that, I think that will be a path that they take. Okay, let's talk about taxes. Everyone's concern is that a Democratic administration will be eager to raise them. The thing to remember about changes in tax law is that any changes require approval by both the Senate and the House. So the way the government is looking to be shaking out now with Republicans still controlling the Senate, that makes major changes under a Biden administration unlikely. Remember, the Trump changes were put through when Republicans held all three branches. So we're not advising you make portfolio changes based on hypothetical tax increases. Biden has floated raising the corporate tax rate halfway back to its pre-2017 level, which was 35%. So he would have it go from the current 21 to 28%, still far below where it was historically. The pro argument with that is that it would not hurt corporate profits excessively, but the con argument is that it could be a drag on fiscal stimulus, which is something we don't want right now. So we wait and see. In terms of personal taxes, Biden's proposals are focused on high wage earners. His capital gains proposal is to remove the preferential rate for those earning over $1 million a year. So basically taxing the gains, the capital gains at the ordinary income rate. This would also apply to dividends. Regarding income taxes, Biden's focus has been on those earning $400,000. This may include reinstituting Social Security taxes at that level of income. The goal would also be to beef up that entitlement system, which is slowly being depleted. So again, all of this is difficult to do, not only in the midst of a pandemic and economic slowdown, but also if the government stays divided. So now I'm going to pass this over to David, who is going to speak to some of the investment ideas and strategies in light of the new administration. David,
thank you so much. Thank you so much, Elaine. Wonderful background. Of course, we are so interested in, what Mr. Biden's going to do and the ins and outs of that. But of course, we have clients who have retirements to save for and to financially create kids to put to school, grandkids to put to school, and other savings projections. So how do we take all this and come up with a way to help your portfolio move in the right direction? And this is a tricky point here because back in March, since March, when we were in the throes of the pandemic, the S&P 500 has risen about 65%. So you might start and say, well, is there any juice left in the stock fruit here? And we actually think there is. We think it's really been a tale of a couple markets. On the one hand has been the stay-at-home trade. That would be some of the tech companies and tech devices, which we've been so reliant upon as we've tried to live our life from home and shop from home and do our work from home. That would also include, of course, your cleaning supplies, your Clorox and so forth, where we tried to stay as disinfected as possible. And of course, your food delivery, your pizza companies, your all that. And meanwhile, of course, the stocks that involved going out and enjoying yourself, whether that be restaurants or sporting events or whatever, those have been left for dead. So we actually think that if, as we know, the vaccines are coming, and we've heard some great news from Pfizer, some great news from Moderna. AstraZeneca is on the cusp of some announcements. Russia apparently has something that even Putin's daughter has taken. So we think that there's going to be better news on the health front. And then if we combine that with some fiscal stimulus and perhaps some infrastructure spending, we think this economy can move ahead, and we'd actually be looking for those types of investments that are cyclical, that do better when we have a better economy. Value stocks, which when growth is scarce, people chase the growth stocks. When growth becomes more plentiful, then people are also looking at how much you're paying for growth, because everyone has growth. And of course, we're also looking for stocks that pay dividends. What are we a little cautious on? Fixed income. Because if the economy turns up, that could put the pressure on inflation, and lenders will demand more to loan you money. And we all know the bond math is, as interest rates go up, the older bonds, which are yielding less, have less value, and so they could go down. So that's something to watch for. Also, something that we're looking at very closely is REITs in real estate. Why that? The beauty of REITs and why they've actually outperformed the overall market for the last 60 years is they don't pay any taxes at the entity level. It's all distributed out to the shareholders, who of course then have to pay taxes. But if you don't pay taxes at the entity level, you may not be so worried about potentially higher corporate taxes. So that could give them a tailwind. And finally, municipal bonds may start to look more attractive. If taxes go up for the wealthy, then it puts the pressure on you to find things that are going to sidestep those tax increases, and tax-exempt bonds could be one avenue. Next. So let's take a look at cyclical and value stocks. They've been long-term underperformers, at least going back for the last decade. But if you go back 100 years, then actually stocks that have traded at a lower multiple of earnings, of cash flow, of book value, of revenues have actually outperformed, because traditionally people tend to pay too much for the two in the bush as opposed to the one in hand. But recently, that has not been the case, as people have clustered in the mega cap tech stocks right at the top of the market. However, there seems to have been a change in tone on that starting the second day of September, and recently indexes of value stocks have actually outperformed growth stocks. And certainly, if we can anticipate smoother trade relations, if we can anticipate finally a stimulus package in Q1, if we can get that infrastructure package, that could give a tailwind to these value stocks. And of course, perhaps because of the vaccines, we can re-engage in the economy. And so that trend may have started September 2nd. We think that could continue to perform well for people. People say, well, how long is that going to go on? Well, there's been 10 years of underperformance, so maybe there is 10 years of outperformance. Next. Part and parcel of what we'd like going forward is smaller stocks. Now, you see this chart goes back nearly 100 years, and the top blue line shows you what you would have made if you'd put $100 in small stocks, and you would have made more money. You would have ended up compounding all your returns over since 1926 with about 32,000. Well, if you put in large caps, only 7,000. So over the long haul, smaller companies have actually beaten the larger ones soundly. Now, why would that be? Well, smaller companies are less subject to regulation. They have smaller market shares. They have a chance to grow. They're taken over by the bigger people. They are less covered. And so there's more opportunities for research there. And so historically, the smaller companies have benefited. Next. But in recent years, the small stocks have lagged. Over the last 5 years, they've returned 7% less annually than the S&P 500. But just recently, again, going back to the beginning of September, the Russell 2000, which is a well-known benchmark that measures their performance, has started to motor ahead of the larger stocks. And in fact, just this week, entered all-time record territory. We think that there's more room to go. Why? Because typically smaller stocks are more expensive, and right now they're cheaper actually than large stocks. So we think they have a valuation edge. And of course, since they've underperformed for close to a decade, we think there's going to be more than just the last couple of months. So we would advise clients to tilt portfolios a little bit toward the smaller guys. There's other reasons why they could be outperformers. One is to the extent that overseas economies, let's say Europe and Japan, lag, smaller companies may have an advantage because they're less exposed to the lagging overseas economies. To the extent that, for example, trade wars, we know that under the Trump administration, there's big trade tensions with China, which culminated in all sorts of tariffs. The best advice now is those tariffs are not going to go away, that even a Biden administration will want to extract some sort of concessions before ending those tariffs. So we think those trade tensions will not just disappear, and smaller companies which don't do business overseas were less exposed to that. Smaller companies also have a little bit more exposure to financials, which have been big laggards, but that could turn around too. The most important thing for financial stocks is what they can earn on their money, whether they're making a loan to you and me to buy a home or to start a business, or an insurance company investing the premiums before they might have to pay them out. So if interest rates go up, that could be a real tailwind for financials. And if the economy improves, interest rates could go up, financials could thrive. Next. We also like dividend stocks. Now, you would think that dividends paying stocks would have really outperformed, given that the Federal Reserve has squashed interest rates to microscopic levels. But think again, they actually haven't, and that's because of the fear on the economy due to COVID. People said the dividend looks attractive, but what if they cut or eliminate the dividend? So people have actually moved away from that area of the market. And that is contrary to what we've seen over the long sweep of history. Remember, when you go back for the last 100 years, close to half of all the money investors have made have come from the dividends being paid out, not the capital appreciation. So that if you're looking at a good dividend paying company, you're probably more likely to get a better total return. In fact, our chart on the left here shows the long-term performance in the white line of dividend-paying stocks. And then you can see the cliff, and that goes back to March. And of course, the non-dividend paying stocks, that would be your Amazons, your Netflixes, your Googles, they continued to power up while the dividend stocks didn't enjoy that same rise, again, because many people were skeptical that those dividends could continue. But now that we've got potential stimulus, bigger stimulus package, infrastructure package, and of course, the vaccines, we think people are going to be gravitating back to dividend paying stocks. Now, admittedly, the timing on all this stuff is always uncertain. And, we'll know more, as Elaine mentioned, after the runoffs in the Georgia Senate race. But it would appear that dividend stocks are poised to do better and regain their historical outperformance. So what's our tip to people out there as to how to pick their dividend stocks? We like the dividend aristocrats. What are the dividend aristocrats? Those are stocks that pay dividends and are in the S&P 500. So you've got the S&P 500 screen, but they don't just pay dividends, they have increased their dividends, and not just a couple years, 25 years in a row. So we like to look at those 65 stocks and then roll up our sleeves and research them to come up with some of the best performers. Now, of course, there's no magic bullet. There's no perfect vaccine for portfolio improvement, because what a company has done, even for the last 25 years, is in the rearview mirror. And we're all about trying to figure out what's in the windshield. So it's a tool, it's a clue, but it's not a buy list either. And again, we've seen since March, dividend stocks lag. No one quite knows exactly when the pace is going to be picked up. Always stay diversified, but that looks like a good bet going forward. Next. So healthcare stocks may also be an opportunity. And what was most interesting is we were just reviewing the recent changes Warren Buffett made in the Berkshire Hathaway portfolio, and he actually added major stakes in Pfizer, Merck, and AbbVie. And one thing that they all have in common is they all have a dividend yield that's more than double what the average stock in the S&P 500 is. So if you too agree that dividend paying stocks can make some sense, and if you too are impressed with Warren Buffett's track record, that's another reason to follow him down the path of some of these healthcare stocks. Also, healthcare stocks have been under pressure because there's all these questions as to what our healthcare system may look like. And of course, we have a change in administration. And certainly on that side of the aisle, there's been more pressure for price controls on drugs, reimportation from overseas, perhaps have a single payer. And that has kept investors away from that area. But historically, we've seen that, for example, with Hillary Care and Obamacare and so forth. And finally, it comes back to business as usual. And we think that there will be a renewed respect for the healthcare industry if they can actually come through and get us out of this pandemic. And people will realize research is important, and we need to have a strong private sector there. And of course, Joe Biden represents not the progressive wing of the Democratic sector, but more centrist. And so that's another reason to think it will be business as usual for healthcare. So you have lower prices, good dividends. We think that's an area to look at adding to your portfolio. Next. Tech stocks. So, the question is, Dave, well, where are you going to get the money to buy some of these ideas you have? We think tech stocks may have to pause here. Why is that? Well, certainly we, as well as everyone, realize the future is tech, but we always have to be careful how much we're paying for it. We've been doing this for long enough to remember back 20 years ago in the dot-com bubble. And back then the mantra was the future is the internet. And they were so right. But tech stocks had gotten bid up to such nosebleed levels that the 30 months after the peak of the bubble in the year 2000, tech stocks lost 80%. And people talk about 80% here, 80% there. When you're down 80%, the mathematics of the investment world means that you have to then quadruple to get back up to flat. So an 80% decline is not something to take lightly. There are other reasons why tech might just slow a little bit. We have stayed at home and used the services, the Zoom and the DocuSign and so forth to try and do business from home. But, people may at some point do a little bit less business at home. And besides, that's now standard stuff. Also, of course, we have a new administration. And although on both sides of the aisle, everyone's looking carefully at the monopolies that these tech companies have started, the Dems are perhaps more likely to say this has to stop. And we have seen with IBM and AT&T and going back many generations before Standard Oil that ultimately there can be pressure to break these companies up. But even short of that, people are concerned about whether they're paying their fair share of taxes. That's not a concern just here, but also, of course, in Europe and elsewhere. And of course, people are looking very hard at privacy implications of having tech have so much data on us, failure to police social media, and what that can mean for elections and fair and balanced information getting out there. So for these reasons, tech is under pressure. Of course, valuations are much higher than at the start of the year. We know that at a certain price, you do have to pull back from the table. And of course, remember, although tech can be the future, we don't necessarily know what part of tech we'll actually use. We've been around long enough to remember when we had our Motorola clamshell phones, and then we got into our Nokia, and then of course we had our Blackberries, which we just loved. Now we got the iPhone. Our guess is 10 years from now, there'll be something that will replace the iPhone because everyone around the world is looking for something to improve on that. So it may not, we'll love our tech, but it may be different companies, different products. Next. So at this point, those are some of our ideas in terms of how you can make money from Elaine's great perspective on what the Biden administration may or may not do here. At this point, we would like to take some of your questions. We've got one from one viewer here, quote, how will REITs be affected by corporations leaving cities and keeping employees at home even after the pandemic is over? And let me field that one. That's an excellent question. Of course, I know who submitted that, so I'm not surprised here. So we just don't know what will happen. Certainly, there are people like Jamie Dimon, who runs JP Morgan, and says, I don't think that people can be productive working at home. I think people have to return. And certainly everyone working at home, that's not good for the newbies in the workforce, the young people who need to network and so forth. So that's subject to debate. But of course, it's handicapped here because many of the office REITs are down by half of what they were in February. So the thinking is that even if ultimately 20% of the move to home is permanent, that still leaves room for recovery and so forth. Remember, of course, major tech companies like Facebook, like Alphabet, have just entered into huge leases in New York City for office space. And their thinking is, at the end of the day, young people want to live in the big cities. That's where the action is. If you've ever looked at a New York City apartment, you really can't work very successfully from there. You can't cook there, you can't work there. So that's where we think the young people will be. So some of the largest tech companies are making a bet that people will return to the office environment. And one little silver lining, remember the last 5 to 10 years, it was how crowded can we make everyone? No one has an individual office. Everyone's working at a bench so that they're cheek to jowl and all the screens are lined up. It may well be that safety protocols dictate perhaps everyone have their own office, but certainly we have more spacing, and so actually more space could be required. Great question. Thank you. Elaine, are you up for this one? How will Amazon affect healthcare in general? We know that they just announced a big push to start pushing pills. Will everyone be happy to wait 48 hours to treat their kids' earache, or will there still be a room for your traditional pharmacies, for example? And will those traditional pharmacies also have their own online offerings? What do you think, Elaine?
Well, I think we never like to underestimate the power of Amazon and what they can accomplish. If we do look in our own neck of the woods, you know, a lot of those independent pharmacies have closed or merged into the big, you know, the CVS and the Walgreens. And the CVS and the Walgreens have done quite a good job, I think, especially having used them during the pandemic, of ramping up their online and, you know, getting prescriptions delivered to you. So clearly you saw the Walgreens and the CVS stocks, you know, they did not take the news of Amazon's entry well and did have a little bit of a correction. But, you know, I think it's going to be another battleground for competition. I think those of us who still like to, when the pandemic's over, go into our grocery stores and shop around, that'll still be an important place for us, just like we like to go to our grocery stores. But Amazon is a formidable player. But CVS and Walgreens also have strategies in place, so I think it will be a fair fight.
Totally agree with that. And of course, the questioner said healthcare in general. I will bet that Amazon will be very loved if they have a very cheap vaccine that they can distribute in January and February. But the reality is it's Pfizer and Moderna who people are so excited about now, so that even if you want to buy it through Amazon, you're still going to be checking off the Pfizer and Moderna box. So there's no plans for Amazon to actually get into the drug development business, but we would love it if they could come up with a vaccine, but we're not holding our breath on that. Here's a question, Elaine. This is also up your alley. What about interest rates? Should I even bother to hold bonds, or should I just sit in cash as my fixed income allocation?
Well, you know, this is the conundrum, because we always tell clients fixed income is there for a purpose. You know, it might not be the sexiest thing in your portfolio, but it is, you know, the ballast to the volatility on the other side when equities take a big move. There's no doubt that, you know, cash rates and fixed income rates are converging. There's not a lot of advantage to be out in longer term bonds right now. What we still do like for clients are some of the bond funds that are very liquid, that will mix different maturities in there. There's still high rated credit quality, and you can still be getting, you know, a 2.25% yield in some of them. So we think that's attractive. You can trade in and out. You don't have to hold it for 20 years. And that will give you a little bit better return than you will see in your cash, which is what, David? You like to check these cash rates every day and make us cry.
Exactly.
0.01 or 0.1, I don't know.
Very good answer on that. I would also note that one of the market's biggest competitions were these high yield money market accounts. You used to be able to get from Marcus and Capital One 2% FDIC insured money market. Well, try looking at that now. Now it's a microscopic, typically 0.5% or less. And people say, well, in Fidelity money market, quite frankly, is yielding just 0.01%. The 10-year treasury is offering 1%. More diversified basket bonds, maybe 2%. You know, it doesn't seem like much, a silly little percent, but on the other hand, that's 100 times more than what you can get in the money market, and everything adds up. And if you can do that using a tax-exempt bond and not have to pay taxes, that makes a lot of sense too. And one of the reasons that we have been big advocates of buying bonds outright versus bond funds is if you buy a bond outright, and that issuer honors this obligation to repay your money at maturity, you know you've locked in a profit. You know what your interest payments are going to be. You know when your money is going to come back. It doesn't matter where interest rates or inflation goes, you've got a profit. Now, could you have done better if you waited 3 years and then bought? Sure. But, you know, if everything unravels here, markets are at all-time highs, actually interest rates could come down further. People say, well, how could they come down further? Well, look at Germany. They're negative 0.5% versus almost 1% here. So they could certainly come down. So we think that there is money to be earned by holding outright bonds versus just being in money market. Oh, it looks like we've got one here on inflation outlook. With all the spending and debt, what's our inflation outlook? Let me try and field this one. So, you know, right now the inflation outlook is challenged. No one is quite sure why, partly because tech has kept our costs low, partly because our ability to do business overseas has allowed people to substitute cheaper goods made overseas for more expensive goods made domestically. But inflation has been challenged. Indeed, Jerome Powell, the Federal Reserve, says it's their big goal to boost inflation. So they don't think it's easy. And so one of, I think, the big tailwinds behind the market is they have promised to keep interest rates low. In fact, below the rate of inflation, which is about 1.5%, until inflation gets not just to 2%, which has been their traditional goal, but over 2%, saying, you know, we'll look at that 2% in the context of where it's been and allow it to creep up. So I think from a stock investor, you want inflation to be higher, because when you look at fixed income and you look at stocks, stocks have generally done better with inflation because they're able to raise their prices and their debt burden goes down with cheaper dollars. Well, bond investors are actually on their back foot with inflation because their return is, well, they call it fixed income, it's fixed. And so as their interest payments come in, they're worth less and less with inflation. So we think that ultimately probably inflation will be a problem down the road, although it's not a near-term issue right now, but it's certainly one reason why we still advise investors to tilt their portfolios to stocks as opposed to fixed income. I think we've got time for one last question here. Elaine, will we ever get a health care plan? Obamacare is limping along and the Republican Trump's promised plan never materialized.
Well,
go for it.
This is a tough question. What I would say is, you know, the Supreme Court has recently signaled that they are open to leaving certain provisions of Obamacare in place. We're in the middle of a pandemic and a recession where millions of people have lost healthcare and jobs. And, you know, this is not the time to be, I don't think there's a lot of political support to be yanking Obamacare away completely. David's point of science playing such a critical role in pulling us out of this, developing a vaccine so quickly, hopefully getting it to market, and you know, this could be a memory in 6 to 9 months, I think bodes very well for the healthcare industry as well as for, you know, people having healthcare and needing healthcare. So I don't know that the formal plan comes. I don't know if things stay in place. But I think there's a renewed focus on the urgency for keeping American citizens protected. So we will see.
Thank you, Elaine, for that. And so we're getting close to our time. We want to respect people's schedules, but we do want to share with everyone the poll results. Marcella, can you show us how the polling worked out? Wow. Elaine, what's your takeaway here?
Yeah, looks like everybody, 81% believe the stimulus package will be completed after President-elect Biden assumes office. Only 19% think it will get done before Trump leaves. So probably not surprising given the contentious environment we're in, but that is the result of the poll. So let's get money for the people who need it and get the country back on the road to recovery, get the vaccines, and hopefully a wonderful investment prognosis. Correct, David?
Absolutely, absolutely. So at this point, staying on schedule here, first of all, we want to thank everyone out there who took the time to watch our presentation. We're happy to share our slides with everyone, and our IT helpers willing also give you a complete recording of the session. And of course, we would love to personalize our thoughts and advice for your particular situation. So don't hesitate to give us a holler if at any time we can give you a complimentary consultation. So with that, we wish you a good day. Again, thank you for joining us.
Happy Thanksgiving.